the board of directors and executive officers and members for inviting me to moderate this panel. I'm honored and very excited about the panel discussion. But before I get started, I would like to wish everybody a happy new year. 恭喜发财. We would like to wish you the year of the golden snake with good fortune, good health, happiness, and prosperity. And when I was young, every year my mother would take me to the fortune teller. Back then we did not have computer, I did not even know what economics is about. Even though I took classes in economics, I still do not know which one is supply, which one is demand. So when the fortune teller always told me the same story. This year is going to be better than last year, but you have to be careful. Something unexpectedly may happen. If you are careful, listen to people, you will do well. So in the last 30 years, I have been hearing the same story. So today is really fortunate that we have 3 experts on China is going to share with us their expertise, their experience. Chinese have one old saying: it is better for you to walk millions of miles than read millions of pages of books. Experience is very important. You cannot substitute experience. So we are honored that we have 3 experts here. So let me ask you this. How many of you have been to China? Okay, we have quite a few. How many of you have done business in China? Okay. How many of those business activities that you do are related to private equity investment? Okay, good. So, and you see, there have been a lot of talk about doing business in China, but when it comes to making investment in China, it is still relatively to some early stage. When Andy asked me to moderate this panel, I love the topic. I think the topic is great. The panelists are excellent. I don't quite agree with the topic. It's say evolution. In my opinion, China does not go for evolution. China go for revolution. In 1949, Mao Zedong went to Tiananmen Square, announced the founding of the People's Republic of China. A new China was born. And in 1977, Mao Zedong passed away. Then the Gang of Four were arrested. Deng Xiaoping initiated the open door policy, economic reform, in 1978. That was the most important revolution in the 20th and the 21st century. Our grandparents have never seen it. Our children, our grandchildren will never see that again. China opened up the door. It transformed the global economy. Not just the economy, it transformed the global culture in doing business and also the exchange of the Oriental culture and the Western culture. And in such a short period of time, China had changed from a rural economy to an urban economy, from an agricultural economy to the industrial manufacturing-based economy. And they have migrated hundreds of millions of people from the villages, from the farm to the cities. And China now is the largest creditor of Americans. Everything happened just in the last 35 years. That is amazing. That is not evolution, that is revolution. But I do like this topic because it shows that things, they do change. China have changed the world, and in many, many ways. When they change, it also creates risk and opportunity. China had moved very, very fast. And common sense tells us, if you are driving on the highway, the speed limit is 65. You are driving 150 miles per hour. You have consequences. So after 35 years open policy, China now is one of the most polluted, if not the most polluted country in the world. You see the biggest gap in the people who have no money and the people who have money. You saw news. They went to California. They bought $1 million of houses. They cleaned up all the Louis Vuitton shops in Hainan province. They spent, and just 2 weeks ago, SEC indicted somebody in Chicago for defaulting $150 million of the Chinese who were trying to immigrate to America through the EB-5, the investment immigration. How much money? That's a lot of money. And yet, 80% of the people have less income than an average person in Bolivia, one of the poorest countries in the world. So you see a big gap. And when I first took US company to China, we went there to do outsourcing. We visited factory after factory. Last 2 years, you have seen a drop in the export in the Chinese economy. Now, US company founded, and I just had lunch with one of our members, he said that in manufacturing in America and Europe, the price difference with China is only 10%. When you take the shipping costs, custom, time, and you don't see a lot of benefit of manufacturing in China. Certainly some of our experts will tell you that. I may or may not be right, but certainly there's a good point for us to talk about it. So when you see China is no longer as the manufacturing haven for US company as 20 years ago. And yet China is building up a huge domestic market, consumer market. And you go to Shanghai, you go to Beijing, you are not able to buy a condo for anything less than $200,000. Lucky you can buy a decent, and you can buy 1,000 square feet for about $1 million US. So all those things are changing. But change can be bad, can be good. If we understand the changes, if we understand how we can take advantage of the changes, I think that will create a lot of opportunity for us. When we have opportunity, we also would make the world a better place to go, because 1 + 1 is more than 2. So in having said that, I would like to turn the floor to our panelists to share with you their opinions. They will talk about the macro, and I think most importantly, I would also like to ask them to spend a little bit of time talking about what the opportunities are. And knowing that you have opportunity does not mean that you will be successful. You need to know how to capitalize on the opportunity, how to fund deals, and how to execute. Now, it's the most difficult job for me to do, is to introduce the speakers. Why? Because they are very impressive. They have pages of resume. If I continue to read, by the time when I finish, it's 7 o'clock. So I'm not going to do that. I'm just make a couple of highlights on their resume, and you can look them up on the internet because they have been around. They have done a lot of business in China. You can find a lot of information about them. The format is as follows. Each panelist will have 10 minutes to share with you what they want to talk about. And after that, we will ask them a few questions, and we will leave between 20 to 30 minutes for everybody here to ask questions so that we can have a very active discussion. The first gentleman who is sitting to my left is David Hofman. He's a senior consultant and director North America for InterChina Consulting. InterChina Consulting is based in Washington. He had 25 years of experience in doing business between US and China. He had been involved in all different kinds of business, from manufacturing, consulting, automotive, textile, healthcare, on and on. We are very proud that he's originally from the Midwest. He graduated from Michigan State University, James Madison College, with a bachelor's degree in international relationship, and also got an MBA from the Columbia. The second gentleman is Tom Manning, a good friend. He is now teaching at the University of Chicago and former CEO of Cerberus, Asia. He had been in Asia for many, many years, lived in Hong Kong for 15 years. He sits on the board for many, many companies, including one of the largest banks in China, Bank of Communication, one of the biggest retail company in China, Gourmet Electronic. He is very active. He served on many, many companies, board, advisor to many corporate executives, and also an educator. He graduated from Harvard with a bachelor's degree and an MBA from Stanford. The last gentleman I would like to introduce is Dave Eich. He is the founding partner of Kirkland and Ellis in Hong Kong. He had been active in doing many deals around the world since 1994, when I still had black hair, but I'm still young. He was, two of the deals that he did in 2011 was named 2 deals of the year. He was also recognized as one of the 100 lawyers in the world, one of the top 4 in Asia. He's originally from Appleton, Wisconsin. I'm sure that he missed the Green Bay Packers game when he lived in Hong Kong. And he also is an educator, and he taught at the London Business School, University of California, Berkeley School of Law. He's graduated from Harvard in 1988 with a bachelor's degree and a JD honor from Columbia Law School. Ladies and gentlemen, please join me in welcoming our distinguished guests. Now I would like to ask Dave Hofman to share with us some of his insights.
Thank you very much. Given the group in the room is mixed in terms of China experience and non-China experience, I think it might be useful just to start from when I first went to China in 1982 as a young man doing textile and garment production, just to give you a perspective on where the country's come from to where we are today, because I think it serves to place us in perspective, because while a lot of things have changed, I think a lot of things have also stayed the same, and those things that have stayed the same influence the business dealings that we have still today, and will probably continue to influence them for 20 to 30 years forward until people age to the point where the currently newly educated people with the new middle class start to grow out of the older classes that still remember how things were in the 80s and are still trying to take on their roles or play that part that they think they deserve to play. So in 1982, when I first went to China, Shenzhen was a fishing village which you could look over from Hong Kong, and it basically was very low, one-story building. There was no city. Shanghai still had dirt roads. The road from the airport in Beijing to downtown took 3 to 4 hours to traverse behind donkey carts, bicycles, and the like. And if you didn't have a government car meeting at the airport, you had no way to get into town because there wasn't a taxi to be had. You know, I think it's a very different environment. And also, if you then take that point and you remember also that in 1982, you were still, or the Chinese were still using ration coupons. Whether they had money or not didn't matter. They needed to have a ration coupon that was specific to the city in which they lived in order to eat. And if they didn't have those ration coupons for the place that they wanted to visit, and they didn't have approval to go to that place, they actually couldn't eat there. So they couldn't buy food, there was no transport, there was no way to go between places. There was no freedom of expression, there was no way to communicate dissatisfaction with anything. It was what it was. There were no vegetables, there were no fruits, there was very limited food supply, there was still poverty to a degree. By the 90s, you were still in Beijing in the winter because of lack of refrigeration in people's homes. The city turned into, for those of you Chinese, you probably remember that they had dabai cai, which is the large cabbages, basically packed around the houses during the winter. And they would eat from them as the winter progressed from the outside in, and that was refrigeration. So that was only in 1992. We're talking about 20 years ago. So it isn't so long ago that people in China will remember things like this, and the parents of today's generation lived through that, lived through the Cultural Revolution when they were put into the fields and taken, basically everything was taken away from them, and they've come back from that. So they've lived through tremendous hardship. And now suddenly there is a change which basically has taken China 30 years to do what we did in the Industrial Revolution in 100 years. And the things that have come out of that have been, as we've heard, the pollution today, as we all read about as well, is undeniably the worst it's ever been in the world. Yet, we're at an inflection point. And in relation to pollution, in relation to quality, in relation to a whole range of things that comes from the fact that the Chinese government has realized over the last 30 years that their export-led and investment-driven infrastructure investment policies that have brought China from where they were in 1982 to where they are today aren't going to work forever. And in fact, if you look at the 12-year, the 10th, 11th year plans as we get to the 12th year plan, this has already started to be taking effect. So as you read in the newspapers that China has suddenly changed to this idea that they need to go to a consumption-driven economy, I think to a degree that change happened a long time ago. It's a question of how it's being implemented, and the government at the central level has wanted to make changes for many years, but the economy itself has not allowed them to make the changes that they've wanted to make and have put in plans. Now, the 12th five-year plan sets out some very clear avenues for them to improve and to change, to become more of a consumption-driven society, to become more service sector-driven, to implement financial reforms, to make it fairer for everyone to conduct business, to make it more competitive. These are not things that they haven't been trying to do for an extended period of time, and they're not new. So it's been an evolution. And I think it's also important to recognize that evolution, because while we in the business community have seen opportunity in China for 20 years and everybody's been chasing this huge consumer market, that consumer market really hasn't been there until now. Now it is there, and it is there in spades, and it is not just, it is no longer the Beijing, Shanghai, Guangzhou cities in the first tier that the change is happening. It's because the Chinese have pushed west, have created provincial capital cities and smaller second and third tier urban cities, which now can draw the population that surrounds them to those cities for work, keep them there, allow them to have employment opportunities so they don't need to go to what were the export-led corridors of Shenzhen, Guangzhou, Beijing, Shanghai, that were supporting all of the exports for China. And that now they have opportunities elsewhere that is driving the growth of the middle class. And that middle class is growing exponentially. Depending on whose numbers you look at, we're talking about maybe we're seeing 150 million in the middle class today. By 2020, that number is expected to be between 500 and 700 million. And I mean, numbers vary, but when we talk about the middle class in China, we're talking about earning power of between, I'd say, $5,000 to $12,000 being the majority of the middle class. I know that's a big difference between our middle class, but that's where China's middle class is. The top, say, 10% above that would be earning more than $12,000 a year, and that would be the upper middle class portion of that. And we expect to see that grow as the lower portions grow, such that that would probably equal 100 million of the 500 to 7 million by 2020. And in terms of products that we are selling to China or where there are opportunities, that group has now changed from being 10 million people spread across the coast, which it's been for the last 20 years or so, to being much more spread out, and 100 million that basically are in 50 or 60 cities all over China. And if you look at where we have been good at serving the market over the past 20 years, where the large companies like Coca-Cola, P&G, United Technologies, everyone's been focused in the major first-tier cities, Beijing, Shanghai, Guangzhou. That's where their headquarters are, that's where their major operations have been, especially in the consumer segment, not so much in industrial products and infrastructure, because that's been happening everywhere. But in consumer, it's been easy to take the markets in Beijing, Shanghai, and Guangzhou, where there's a large population, 24 million in Shanghai, size of the state of Illinois, 24 million approximately in the Beijing area. These are markets into themselves, and we've been very happy taking the easy money that's come out of those. But what we've seen in the last couple of years is that those cities are reaching maturation. So if you look at Beijing, Shanghai, Guangzhou, they are almost like OECD countries in terms of their GDP growth now. They're growing at 4 to 5%. The country is growing at, in the future, we think 7, maybe 8, if we're lucky. But that's way down from 10 to 12, which we've been accustomed to over the past 20 years. So that's going to change. The growth is going to become lower. but the growth is also going to change in terms of where the growth is. Not everywhere is going to grow at the rate that we've seen Beijing, Shanghai, and Guangzhou over the past 20 years. Beijing and Shanghai and Guangzhou are going to grow less quickly, and consequently, we need to look to other places for the growth of our markets and for the opportunities. And the challenge, I think, to us as foreign business people working with China in the next 5 to 10 years is going to be, and what we're seeing from our client base is, how do we serve the second and third tier cities? How do we get to the fourth and fifth tier cities, where you're talking about, if you go to second tier cities, you're probably talking about another 30 cities. If you, and there are 160 cities in China that are over 1 million people. So that's one thing to keep in mind. But there are also 600 third and fourth tier cities. Now, how do you create an organization that can distribute product to and serve 600 different cities? Those 600 different cities are in different provinces. They may have different regional qualities. They have different ways of purchasing things in one part of the country than another. You can't just superimpose the way you've done it in Beijing or Shanghai, or even the way you do it here, on the way you're going to do things in China. Everything needs to be adapted. So the challenge that we have is, how do we adapt our business practices? How do we adapt our manufacturing practices to accommodate the specific needs of each of the different regions, provinces, and cities that we might want to go to? And when I see opportunities, or when we see opportunities in China today, we see huge opportunities in the consumer segment. We see huge opportunities in serving people in old age, in healthcare, because these are areas that have been untouched. Yet, the challenge that's there is that they're also, especially when you're talking about healthcare, highly controlled industries or sectors. So it's more difficult to access that part of the economy that's more highly controlled, and whether or not this becomes open to foreign companies such that you can actually make a profit as opposed to just make an investment, that's the long-term answer that remains to be really solved.
Yeah, and you have about 30 seconds.
Okay.
And that's my own reminder. I'm sorry.
So I think that those are the major points. First, I wanted to make. I think that you have to look at growth, and you have to look at where the growth is happening, both regionally, from the size of the growth, where are the opportunities. But it's also going to change. For the last 20 years, everybody's boat's been rising in China, so it didn't really matter where you put your money. It was pretty easy to make money across the board. I mean, relatively speaking, if you do your homework and you go into the right places. That's changing, because now you are no longer competing with new Western companies that are going into the market. The Chinese companies have evolved themselves. There's a lot of small entrepreneurial Chinese businesses that are coming up from the 5th and 6th and 7th tier cities that are competing directly head-on with consumer products companies, with industrial manufacturing companies. They are able to make a product that has the required quality and meets the needs and the quality of the market, and that's what you're going to be competing with. So you need to make sure that the products that you're selling or that you're buying into are actually saleable and will have long-term opportunities in the market, and that's about understanding and doing your homework on the particular category that you're getting into. So,
and thank you very much. Now, then I turn off my alarm clock, so I'm going to be loud.
okay.
Now, and I would like to ask Tom to comment on the opportunity in China.
Great, thank you, Siva. Good afternoon, everyone. Pleasure to be here. Appreciate the opportunity to be with you today. I'm going to confine my comments to really 3 areas. First of all, China's growth potential for the future. This is what's made China certainly distinctive in the last few decades for all of us as foreign investors. My sense is that it's time to declare this as real, significant, and likely to continue. Certainly when I first got to China, it was all about whether the growth was in fact there or not, or mythical in some manner. We're beyond that today. There are plenty of companies really making money in China, doing very well there. And my sense is multinationals have created an enviable track record as well. We've got companies now like Volkswagen and others, that global companies that have a 25-year history of succeeding in China. And there are many American examples as well, where companies like Boeing, Yum Brands, a whole variety can point to business models that they've succeeded in developing in the right way. The real issue is the kind of change coming up in the next few decades within China, and particularly the next decade, as we tie the growth potential to the new regime that's just taken office in China. What will that decade look like? How will it be different than what we've just experienced under Hu Jintao and his administration? My sense is that we're on the verge of a really new, different era in China that will spell a lot of difficulty for the government. It will probably spell additional freedoms for citizens in China, and it will probably spell challenges for us as multinational investors. And let me go through those for a moment. China is essentially trying to move from a production economy, as we know, to more of an innovation-based economy, moving from manufacturing to services, and from business orientation or export orientation to one that's more stabilized by the virtue of domestic consumption. As it goes through all of this, not only is the macroeconomic management more complicated, albeit admitting that I think the Chinese have demonstrated they have a very deft hand at keeping the macroeconomic variables in place, and maybe even more adept at that than many of the Western countries have been over the course of the last few global economic crises, as well as the Asian financial crisis in '97. But the challenge, in a sense, for them is to manage the migration between the easier phase of growth, meaning the growth that comes from just organizing yourself for the first time, getting resources in place, chasing large opportunities, really enabling industries to become commercial in the earliest economic development phase of an economy that's coming out of a communist era, transitioning to a capitalist era. And I don't mean to belittle that. That certainly was extraordinary and probably the biggest economic transformation we've witnessed and the world may ever witness, in essence, because of the scale. But the harder part may yet be ahead of the government, because to move from the productive economy, production-oriented economy, into one that is more based on information, on intellect, on the protection of patents and ideas and thought and the like, requires much more attention to those behavioral variables that are actually far more difficult to really influence centrally. And they are variables such as trust, confidence, ethical behavior around how to use information that may not be your own, but how to share your information with others in a way that allows for more productive innovation across an industry or across many industries to occur. And to a large extent, there is just too much fumbling at this point in time to suggest that that transition is going to be easy. Even the Chinese leaders themselves are a bit befuddled as to whether this sort of transition requires simply new laws or a new framework, meaning administratively spur it, push it along, or whether it requires a true sense of value adjustment, person by person in a sense, a recultivation perhaps of Confucian values, or an installation of some global values, or maybe even the Communist Party adopting new values that are more appropriate to the current era and attempting to promulgate those in more assertive ways than they have in the past. So there's quite a debate going on as to how to get this softer side of the society and thus the economy in gear so that innovation can actually come about as a result. Because what we're seeing today is that it's no longer the MNCs complaining about lack of IP protection. It's actually the domestic companies. There are plenty of entrepreneurs who are feeling ripped off and vulnerable, if you will, to loss of their ideas and their hard work. They're demanding that more attention be given to putting teeth into some of the laws that have been put into place. And there are good IP laws, believe it or not, on the books. They've been on the books for about 6 or 8 years now. Some mimic US laws, others mimic European laws in terms of patent protection, but they've not been given enough force, they've not been utilized in the ways that you might expect. The fact that the judiciary does not operate independently, of course, doesn't help, but even administratively, the government, through its various organs, could be promoting the use of these intellectual protection laws to a greater degree. I think we're seeing some progress, but fundamentally what's standing in the way is the will to actually adhere to some of these laws, the ability to kind of use them in the way that benefits a broader cross-section of industry and academia, so that people are willing to exchange information and the like. That's one aspect. The other aspect, of course, is national companies moving to global. We're seeing a lot of globalization of Chinese companies. I think that degree of change is profound. I think we will see a number of these global companies operating in conjunction with China's sovereign wealth funds. As they increasingly do, they'll be reshaping a number of industries worldwide because they'll have the resources to actually buy up scarce assets in various countries. We're certainly seeing it in the natural resource category. We're seeing it in a few of the electronics categories. And over time, that's just going to continue. So that suggests a real coming of age and a much different modus operandi than the way China had behaved corporately in the past 2 decades. And then finally, I think we're seeing China step forward as a leader in a lot of instances, no longer content to be the follower, no longer relegating itself to the back position, but in effect stepping forward and, if not being the active leader, at least being a veto on what a number of other either nations or organizations are recommending. And that ranges from the government organizations we're well aware of all the way to standard-setting organizations within certain industries. One of China's abilities, because of its scale, is somewhat unique in the world today, and that is to set standards for new innovations as they occur, because China is both the largest consumer of some of those products, if you will, in, say, the electronics area, as well as the manufacturer and the channel controller to a lot of other marketplaces. Thus far, that particular technique's only had modest results, but I think we'll see that increasingly utilized. So we're going to see China flex its muscles in various ways. All of this is to say that China is becoming far more sophisticated in many, many ways. That sophistication, I think, will challenge all of us worldwide. And my concern is that as global businesses here in Chicago or nationwide in the States, we're not playing this in the way we should. And I'm not suggesting that we need to be frightened by this or fearful of it, but we need to be respectful of the fact that there is a new player on the field that has incredible potential athletically and intellectually. And I find that most companies are just taking the entire China model too casually. They're pretty happy they have a China strategy 101, and they put it in place for a while, seems to be working and the like. But frankly, they're not recognizing the sophistication that is now required, because the China companies are not going to play at a 101 level. They're moving up to 301 very quickly, and they should not be underestimated. They're going to be very good competitors. Net, I think this is great for the U.S. companies if we respond, because it will raise our game. It will require us to be a lot more precise, a lot more specific in how we go after China opportunities and the like. And my sense is there's reason for optimism on the opportunity front. This sort of chaos, this sort of change provokes all sorts of loosening of industries, changing of industries and the like. We can play in a lot of that. David, I view a number of the industries as really being interesting. He's mentioned a couple. I'm sure in the discussion we'll mention a few more, but I would not neglect business services, for example, as a very interesting one, because to me that is sort of the middle class of business corporations in a sense. A lot of small and medium-sized enterprises rise up, take hold during the growth of development of a new economy. And they represent a huge amount of business in terms of air travelers, in terms of hotel use, in terms of restaurants, all the rest, all the services you can imagine, plus all the services that their companies might be ordering in the background. And outsourcing, even within China, is becoming a much more pronounced trend these days. So many opportunities, no reason to be discouraged about the China evolution going on. I would argue, much as David had alluded to, there is a revolutionary element still within the mix, though. And we would do well to recognize that we need to revolutionize our own approach to China quickly. Otherwise, we'll be lured into sort of a complacency that I don't think will serve us very well and allow us to compete successfully.
Thank you very much, Tom. Dave?
Well, for concision and provocation, I'd like to just disagree with the other panelists in their entirety.
We knew you would. Well, I mean, that's what makes this panel exciting.
I can't do that, but I will try to give you a little bit of a different perspective. I was a developed markets buyout lawyer and represented mostly big buyout funds in complex cross-border transactions in big developed capital markets with a lot of syndicated finance and layers of capital structure and so forth. And maybe I can make three principal observations. The first is a couple of vignettes. The second is what I think the state of private equity in the last year in China is as a window on sort of deal making, some of the challenges and hurdles that businesses face, and then finally what I think a few of the principal obstacles are looking forward to building that market. First, when I was still in Europe and I was looking at, it was probably the first big levered deal that I was going to do in China. It was a resource deal. It was a typical play. It was to shut down the asset in Europe and to effectively augment the asset that already existed in Asia. And in buyout transactions, advisors are trying, obviously, always to stage expenses as late as possible. And I asked what the basis for this huge diligence trip to Anhui province was going to be and whether there was actually a deal. And they said, of course there's a deal. And I said, could you fax me over the letter of intent? And they said, sure. And I kept waiting for the fax to come all day. And finally, I had a secretary go in and talk to the copy guys, and they said, well, there is one page here that was sent 4 or 5 hours ago that had one paragraph on it. And it basically said, yes, we are delighted that you are interested in the potential transaction over which we have sovereign authority, and we encourage you to proceed. And that was the basis that all the fees were going to be spent on. And then when I got to Anhui, the vice chairman of the government showed up, and he, after lots of ceremonial activity, he unrolled this vast map which showed the asset that was going to be acquired. And right down the middle of it was this jagged line, all the way down the middle, and it looked like it divided it very neatly in half. And it was parcel A and parcel B, very large parcels. And I said, well, after lots of other diligence questions, why is this divided in half? So, well, because if it's not divided in half, we'll have to go to Beijing to get approval. But if we divide it in half, we can approve it ourselves. And it's the first time the light bulb went off for me about what title actually meant. I never thought in any deal I'd ever done before, having run UCC searches and lots of other diligence tools, that I actually had to worry about title. The second occurred when a 25-year-old guy popped into my office in Hong Kong, slick back hair in a cool suit with his buddy, and he said, yeah, we hear you raise private equity funds, and we're here to raise a private equity fund. And I said, that's great, I'm happy to chat with you about that, and asked him his background and so forth. He said, well, we just want to cut to the chase. And so I explained to them how fundraising process would work, and he said, I asked him what the target size would be, and he said 500 million. And I said, well, do you have any track record? Have you done this before? Do you have any investing experience? No, but trust me, it won't be a problem to raise the 500 million. And I thought, I couldn't wait to get that guy out of my office. Now, in retrospect, I'm sorry that I asked Wen Jiabao's son to leave my office. And the third is one that Tom may find familiar. I was sitting in a meeting room that was just voluminously filled with smoke, high above Hong Kong. And the principal agent of the seller, in this case a listed company, was the HR administrator for the company. And the reason for that was that the stock had been suspended for almost a year, and the founding shareholder was the wealthiest man in China, was in jail. And the way the negotiation proceeded was that the documents were negotiated with the HR administrator, and after many months of negotiations on behalf of several buyout shops, we would receive comments through the bars, essentially, I think, on the document in handwritten scroll, and that's the way the negotiation proceeded. And as I spoke to the US-based credit committees, they asked me late in the deal if there had been any red flags on the transaction. And I thought, well, why, yes, there had. And my perspective was moved by all those things. And what it really was the beginning, the very clunky beginning of a foreign private equity industry and its intersection with the many, many interesting issues, both challenges and opportunities of China. I really look at, while there's plenty of activity going on before that, I really look at 2005 as some sort of inflection point in terms of foreign buyout shops being in Asia. When they first arrived, they all told me they wouldn't look at a deal under 150. I asked them 6 months later, they told me 75. I asked them 6 months after that, and they said 30 probably be okay. And that points to something that remains part of the private equity market in China, which is that it's really not a buyout market, it's a minority transaction market. And there are pockets of buyouts available which are being very successfully mined by sophisticated funds. They include those businesses that were moved offshore prior to 2006 when the M&A rules were instituted. They include now a growing public to private trend and so forth. But by and large, it's been a minority market. And minority rights in a complex capital structure private equity transaction rely very heavily, as you can imagine, on contractual rights. And trying to impose that system on a regime which is effectively relational as opposed to contractual, although it's evolving towards a contractual world, was a very challenging thing. So a couple thoughts about the current state of the private equity market. It is effectively flat over 2012, both in terms of investment number and in terms of the quantity of investment. In part, exits were very depressed. The Hong Kong Exchange is one of the most obvious routes for exits, was operating about half the pace of the previous year. The U.S. capital market for Chinese companies is effectively closed as a result of fraud and many other issues. And fundraising has generated a massive overhang, about $43 billion by some counts, aimed at China, which remains to be spent. So the state of the private equity market in China at the moment I would call tepid, and yet if you put it in context over a 10-year period, it's certainly way beyond where it was 10 years ago. And finally, just a few points about some key challenges. We've mentioned minority rights, mentioned, and I guess that's a segue to lots of corporate law and regulatory issues. But let me pick up on something that Tom alluded to, which is corruption. It's probably not surprising to anybody in this room, but I would emphasize that I find it ubiquitous in transactions in China of any scale. And the result is that for American investors, on every deal, you have to consider whether the FCPA or the UK BA will be invoked, or for that matter, Chinese corruption issues. And deals are getting done because people are taking a view about the nature of those risks, the scope of those risks, how they can be remediated. But it's not clear to me that there's been an improvement, at least in the last 5 years, on that vector and in that challenge. So maybe I'll leave it there, see that as a way to begin discussion.
And thank you very much. I would like to ask all the audience to hold your questions. We are going to talk about a few topics, and we will open up the floor for questions. The more I heard today was we have been focusing on talking about the consumption market opportunity for U.S. company. But deep in my heart, I believe that if the manufacturing sector in China flattens, I think the country will have difficulty. We have seen companies moving out from the manufacturing. And I have a question about manufacturing, but I have basically three areas. Number one, do you think that China is losing steam as the manufacturing center, particularly for low value added product? That's number one. If that's the case, we have seen companies folded. Have you seen any consolidation in the manufacturing sector? If that's the case, how we all sit here can benefit or can capitalize on the opportunity? And does it make sense for us to go to China to look for a particular segment and say, look, they don't know how to manage, we come in with our market understanding, or United States, with our management, technology, we should buy company, do a roll-up, and then we can take benefits of that. Please go ahead. Dave, you would like to start first, and I would be grateful if each one of you spend maybe 3 minutes.
If we talk about the manufacturing sector in general, I certainly think that the nature of the cost structure in China is changing dramatically because of the changes in the middle class, and demands people are making in the workplace for higher salaries, for more leisure time, for less work. The reality is that costs in China are increasing across the board, not just in the manufacturing sector, but across the board in the energy sector, in water resources, across every category of cost area that goes into manufacturing a product. And in the past, those costs haven't been passed along because the Chinese government has basically offered very special pricing to Chinese manufacturers. They've had special deals for locating in certain places that have allowed the cost to basically stay even and not get passed along. But at this point in time in development, those costs now need to be passed along because they cannot continue to maintain them at the low levels. So those costs are coming along, and China's manufacturing cost in terms of the world averages is starting to equal what it would cost you to manufacture a product in Mexico. So the monthly wage rate of a Chinese laborer in a manufacturing facility in pretty much anywhere in China is going up to around $600 a month, which equivocates to doing the same thing in Mexico at that rate. So now your question is not whether or not, to me, it's not is manufacturing failing, it's how does manufacturing survive the cost increases that are going to come about over the next 5 to 10 years. And how does manufacturing also deal with the issue that there really are two levels of manufacturing in China still today after 20 years of exporting. There's still the export market where people are manufacturing one quality for export, and then there's the domestic market where people have been manufacturing the just okay for China goods. And those factories may be the same factory, but they somehow have been able to turn off the quality controls when they make for the local market, which is what has made a lot of the quality problems that we have here so prolific, because we have contracted out our quality management to a contract-based system where we trust that the end provider of that contract is going to be checking our quality for us. And that should never be allowed to happen. You have a brand, you have a product, you need to maintain that quality. That means that you have to follow the production from the beginning to the end. All the resources, all the sourcing needs to be controlled. If it's not, you will have a problem in China. And I think to your comment about that, the reality is if we could help them understand that that's going to help their own companies to build a better product and make better quality, that's something that we can offer. But I think it would be naive for us to think that they're going to necessarily just take what we want to say, our word for it. They have to learn that themselves. And I think over the last 20 years, China has been learning that. And we've now come to a point where, again, the middle class is going to drive this. We didn't have an EPA, we didn't have a Consumer Protection Bureau until the 70s, as I recall. And that was because we started demanding as individuals better quality, better air, better pollution controls. It wasn't because business was out there trying to give it to us. So I think in the long term, the Chinese consumer, as they become more sophisticated and more demanding of a better quality product, because they're earning higher salaries, because they're paying more taxes and they're contributing, they want to know what the government is doing for that. So that's going to influence the quality, and I think that's going to feed into that. Tom?
Yeah, just quickly, I would add that we have seen companies move production out of China. Shoe manufacturing is largely offshore now. A lot of apparel manufacturing is moving to places like Sri Lanka, Pakistan, and the like. So people are very conscientious of the costs rising. There's also another issue, though, which is worker shortage. There's been more mobility injected into the work system in the last several years. People can actually move to different places a little more freely than they were before. Additionally, there's a little bit more of a mindset that they're not so linked to a company as in the past. In the past, a young worker without a college education might migrate to Guangdong or province or one of the areas where there would be a lot of manufacturers with dormitories and pretty much camp out, live there for several years, going back home once a year, et cetera, and be a bit worried about trying to switch companies and the like. Today, that's less so. There are active exchanges and networks that allow employees to find work in other provinces, switch companies. At a white-collar level, the job jumping is extreme. If you're running an IT services company in China, you have retention issues these days. Your loss rate is probably 20–25% of the employees every year. So every 3 years, you have a new company, essentially, with all the training, recruitment costs, and everything else. Meanwhile, the wage escalation is pretty extraordinary, particularly in the East Coast cities or in the pocketed areas where your particular industry might have a major home. Tianjin, Shenzhen, other locations where you might find electronics or particular manufacturing sectors very active. Usually there's a mini market there that has seen escalation on the order of 15 to 18% a year in some of these categories. So very significant drivers. And you look at companies like Foxconn, for example, which employs 1 million workers in China at this point in time. Their belief is that the next 1 million equivalent workers will actually not be people, but will actually come in the way of automation. And that's an important thing to underscore, because it'd be easy in this sort of debate to get lured into thinking that it's all about people and workers, and China's all chock full of people in abundance. The fact of the matter is there are dislocations, unevenness in terms of the nature of trained workers, where they're located and the like, as well as the phenomenal aging that's going on in Chinese society. A more pronounced aging curve than in the States, in fact, one that almost mimics the Japan curve. So consequently, you have to look toward automation. And the most impressive plants I visited in the last year have been auto plants. Brand new auto plants with 89 workers, or 103 workers. I mean, 2 examples in particular, real numbers. And so completely automated, among the most automated in the world. And a lot of people who visit those just can't believe they're in China. But that is the future of China production. And I think China ultimately may have the problem the U.S. has. So if you say that they're emulating our 100-year model, at some point they're going to come across the 9th decade of that model, where they have dislocations across the economy and don't know what to do with surplus would-be manufacturing labor, when in fact they've automated to an extent. That's probably about a decade out, but it's not too much farther than that, given the rapidity of change.
Yeah, I echo the first couple of points. Foxconn's a good example of wages being increased to manage worker unrest. As many of you know, Foxconn has a lot of issues with its labor pool And certainly the case that textiles and other businesses have been moved to Southeast Asia. But I think to address the consolidation point, which was your last point, Siva, a restructuring regime was adopted in 2008, but it is largely not yet applied in a recognizable form to those familiar with Chapter 11. And part of the reason for that, there are exceptions, but part of the reason for that is that there is often a constituency that may not own shares but has sufficient control over an enterprise in any given area, and that's the local or provincial government. And they have a lot of levers they can pull to prevent anything other than effectively a liquidation occurring in respect of any given enterprise. And as a result, we don't see any sort of typical bankruptcy type results in troubled industries.
And let me make a couple of comments. I certainly agree with our panelists about the automation. The result is uncertain because the Chinese, Taiwanese, they are good to mobilize millions of people to build a factory. So when they break the manufacturing process into a series of small steps, that's what they are good at. When it comes to automation, they don't really have the experience to build a robot. We don't see many, very few. I think that may be some advantages we, our country, have over China. What do you think? And if that's the case, how can we go in and then take advantage of our expertise and implement into China in light of the rising labor, aging population, and they try to move up to the food chain of the manufacturing? Well, when we start with the other thing.
Yeah, sure. I mean, it's kind of a continuation of the earlier point, only in respect to private equity funds. And I think, you know, they're really not investing in these highly commoditized areas, and the sorts of areas that they're investing in are these, where there's some available synergy, often with a portfolio company elsewhere in the world that has technology, where manufacturing prices may be lower, but where in fact ultimately there might be a domestic market for that product, or whether there's some synergy jointly to market elsewhere in the world. So I do think it remains a comparative advantage for a lot of developed countries, and I think one of the interesting deal flows, which has absolutely exploded in the last year and a half, is outbound investment to Europe from Chinese companies. We're involved in 4 or 5 very large transactions right now, all on behalf of what seem to be highly unrelated, very large Chinese enterprises in respect of assets that are either troubled or attractive from a technology profile in Europe and in Latin America. And Germany in particular has been the focus of a lot of consideration by Chinese companies with that in mind.
I would add that a number of private equity firms have been active in trying to put together pools of capital that allow them to play across the barrier, in a sense. Money that can be invested into China to help consolidate in a certain sector, achieve the economies that might come from that sort of consolidation, mergers and the like. Auto sector is a great example of that. We're 20,000 parts companies in China. You need about 2,000 essentially, even by government estimates. 40 companies assembling or manufacturing cars. The government would like to get that down to about 8. So consolidation clearly on the agenda, government backing and the like, a lot of capital now chasing that transformation, that industry transformation possibility. But if you do it only in China, you're kind of optimizing within a shoebox that's a bit undeveloped at this point within a perimeter. So a number of private equity firms have looked at combining an in-country funding ability for deals of that kind with an external funding, a global funding ability, so that they can go buy stranded assets, which are a little less common these days in the auto industry as the resurgence is beginning to occur, at least in the States. but certainly across Europe and certainly within some U.S. companies, there is still some hiving off that is underway. The idea being, take some of that foreign asset, if you will, bring parts of it into China where there is still a manufacturing benefit to be gained, but also begin to transfer in some of the automation techniques, which go back to Siva's concern. China is probably not going to automate fully on its own, but is probably in the importation of automation methodology at this point in time, and will benefit from having multinationals further instruct its companies around all of that. And the only thing that cuts against that, I would argue, is that with the earlier points about wages rising and the like, I have had a lot of conversations with Western operating executives who are now looking at the automation benefits they are seeing in the U.S. Vis-a-vis the cost of manufacturing in China and an ability to bring at least some product back. It's not 80% though, so we're never going to bring it all back. My sense is that we may end up finding a marginal 10% or something that we can actually bring back even with higher automated techniques. So you know, there is something there. You have to find the right pathway in your particular industry, obviously.
To follow on to that, I also think that this is one of the beginnings of some of the global partnerships that could happen between Chinese and Western enterprises, whether they be American or European. And I think you've started to see that with General Motors. You've started to see that with General Electric, in terms of their relationships with the Chinese have become so strong and intertwined in terms of some of the product lines that they're looking at how do we cooperate with the Chinese, bringing product from China to other markets under the GM/joint venture with the Chinese, and support each other in the sense that we're going to manufacture it in China, but we're going to sell it using our network globally. And I think that that is really a new strategy that larger MNCs can start, or are starting to focus on, because it's win-win for both. And we can bring something to the table that they don't have and that they need, and likewise they can bring the product to us at a cheaper cost than we could manufacture elsewhere, and it's going to become more a global market. That said, I'd like to comment on one thing that Dave said and just turn it around for a minute, because I think that what Dave talked about relative to the way private equity has been going into the Chinese market could be reversed if you sit here in the United States and we think about the way we sell businesses. And I think that we read in the paper about how much Chinese outbound investment there is in Europe and the United States today, and how it's growing and growing and growing. And a larger part of that right now is financial investment in securities, or in a percentage of a publicly listed company, or in resources somewhere globally. When you look to the market here, and when I'm dealing with people that are trying to sell businesses here, everybody seems to think that there's a Chinese buyer for their business. And I think this is where I would turn that around, because the reality is that we just don't understand that the Chinese don't buy at auction. They don't understand our process. They're not used to being in a process. And our buyers don't understand, and the Chinese don't understand. So when you're trying to sell a business and you're trying to do it on a time scale of 5 months, and you've hired an advisor to do the deal based on this, and you want Chinese buyers, the Chinese buyer isn't going to give you an indicative price until he's been into the data room. But you're not going to let him in the data room until you give him a chance to look at, give you a price. But they won't give you a price. So the timing is completely disconnected. So, and I think that also that's going to have an impact on how we see Chinese middle market companies or large companies buying Western American specifically, because European are different. I think it's much easier. I think you have to take the position, if you're going to try to develop, or if you're looking to develop a relationship with a Chinese company that in future could buy a company here, or you want to sell a piece of equity that you have in a company, it's how can I identify a Chinese buyer today that 3 years from now, when I'm ready to sell a business, is in a position that he already understands my business enough that he's willing to make an offer before I go to auction. So I just wanted to point that out.
Well, and we can get back to this topic later. Tom raised a very interesting point in China, try to spend more money in research and development, moving up the food chain. United States and China are the two largest funding sources for research and development right now. However, we have not seen many innovative products out of China, such as pharmaceutical. They did not come up with any new drug. So all of us sitting here, how can we participate in the enormous spending by the Chinese government on research and development in China? Should we have a research and development vehicle, send it to China, work with the local company, try to participate in those funding? Or should we bring to China some new product that close to being commercialized? Find a Chinese company to license and to work with us. Tom, would you like to go first?
Sure, I'll jump in. My sense is that more companies, more multinationals, American multinationals, are becoming comfortable doing R&D in China. This is quite different than even 10 years ago when people were still rather cautious about even doing product development in China, much less basic R&D. But we're now seeing that a number of true science companies are doing considerable amounts of basic research, fundamental research, the true R, and not just the D in China. Still with a high degree of anxiety, still following a variety of risk management techniques in terms of project breakdowns, integration keys that remain offshore, if you will, all kinds of protective techniques they're trying to still employ. But if you look at somebody like Microsoft, for example, I can recall in 2000 when Steve Ballmer, the current CEO, was just heading to China. He said that he was on his way to Beijing to find the first 100 engineers at the Chinese Academy of Sciences. And today they're up to about 7,000, in the broad network. And so the confidence has risen pretty dramatically. And if you look at any of the electronics companies, you'll find that most of their R&D was basically done at a manufacturing location. That's now morphed into 10 or 15 higher level development labs where there's more product integration actually done. So we're seeing more confidence overall. Those who are cautious would still say it's false confidence because there's still a lot to be fearful of in terms of theft and the like. And I would argue that we may not see enough protection come fast enough to really make everyone comfortable with this method. But China is, in a sense, a place that makes competitors better. And if you really believe in your innovation, you'll kick the engine and keep it revving as fast as possible because it may be more about shelf life than patent life. And that's what a rapidly developing market like China will do for companies that are otherwise a bit laid back around the innovation game. I also think that we will see China develop further substantive innovation over time. And it may be a little tough to determine if that's driven by multinational investment or Chinese company investment in a sense. Because if you look at a lot of the stats these days, the patent office in China as well as in the States would indicate to you that Chinese inventors invent about a third of all inventions worldwide at this point. Big numbers. Not surprisingly given the scale of the country and the scale of science in China. But a lot of those scientists work actually for American multinationals. So it's not quite clear at the moment where a lot of the innovation is being housed or how it's being controlled. I think over time all of that data and research will yield some new answers. My sense though is China, having led the world 1,000 years ago in innovation, has every bit as much capability today and every bit as much ability to do that again. So there's no reason that it should be doubted. It's just a matter of getting that act together and making it happen.
Well, let me answer the question. For example, we have some private equity firm here. They own a company. The company comes up with a new product. It's not 100% commercialized in America. Can they find a partner or a licensee in China willing to take the risk, pay the money, or take on the responsibility, try to commercialize this product in China? Can you understand my question?
Sure. How long do you want to keep your product?
You have to tell me.
While I agree with Tom that people are and will have to take the calculated risk on their IP in particular, and so I think the answer to your question, Siva, is that just like any other aspect of a joint venture, people are identifying reputable partners that they develop trust and incentivize properly with, and as a result could engage in such a transaction. I'm on the risk receiving end of those things most of the time, and I still see incredible, sometimes absurd results from IP sharing. I mean, I did have last year a complete mock-up buyout fund set up in Beijing with signage, signboarding, website, everything, instead of a global buyout shop, and it required effectively chasing that entity around the world to shut it down. And those sorts of circumstances still occur. I think at the more sophisticated level of real innovation, I think the risk really relates to incentivization of your partner and understanding the network of commercial relationships they're in, which maybe goes to Tom's point that shelf life rather than legal protection is ultimately a more important factor.
But the other thing I think that relates to innovation in regard to that is the product that we're talking about, first of all, something that is really needed, and does it have the legs to actually be sold in the domestic market? Because a lot of the issues in China today are that the products that we make here or the products that we are innovating at the high end are not really what the masses need or what the government wants to spend money on. So from our experience, when there is a product to be licensed, first of all, if you're looking at pharma or you're looking at medical equipment or you're looking at that sort of high-tech area, unless it's something that it can be immediately put into sales and generate revenue for a Chinese company that's listed, they're looking to build that market, or they're looking to do an IPO, so they want revenue-generating products. They don't want products that haven't already passed 510K approval or whatever the approval is for that product. If it hasn't gotten approval and it doesn't have a market already, it's not really on their radar right now. They're not interested. I think generally that would be my opinion.
Let's talk about negotiating deal. Tom, you said that the biggest problem is corruption. When President Hu Jintao stepped down, he said that corruption was so bad in China, if they didn't fix it, the party would collapse. We have to remember that, not the country, the party. It took Hu Jintao 10 years to understand that it's a little bit different. So, U.S. companies always complain they are in a difficult position when competing with European, Asian companies because they don't have a Foreign Corruption Practice Act as tough as we are. So when you do that, how can you get around it? And do you find a joint venture partner and, hey, don't ask, don't tell, okay? And they do whatever they want. And how do people get around it? And they find a partner and have the partner handle those things, and if you do real business, can you do something? It's better and it's legal, and yet more effective than paying money under the table. Dave, would you like to go first?
The problem with trying to do any of these things is that your competitors are going to do it the way Chinese companies do it. So if you can't compete on the same basis that they do, it doesn't matter what the Western Europeans are doing, it doesn't matter what anybody else is doing, it's what is the local market doing? And until that changes, I don't think it really matters how we do it, because we're not going to be competitive. And I think that you've got to be, the FCPA stops you from doing a lot of things, but there are workarounds. What does that mean? It means that you're going to have a higher cost to your product. So you have to find another way of skinning that cat so that your product is going to be competitive in the market, because everybody else is going to still be cutting the corners and they're going to be doing it however it's done, because that's the way the market works.
I would just add, I think from our standpoint as U.S. citizens, there's you know, that there's a clear path here. We are committed to doing things in an ethically high manner and an appropriate way, and we have to accept that that may exact a certain cost for us, but it'll just require us to be more innovative in other areas within the business model. And I've seen that work out well. I think actually in the longer run, being ethical about how you conduct your business has positive repercussions inside one's organization. Because Chinese staff and employees, even though they are well aware of how business is done in China, do recognize that the sword cuts both ways. If they're cheating someone, ultimately they will be cheated out of a promotion or out of a deal or something of the sort as well. And they would very much like to be within an environment where, in fact, there is a change. They can be made more comfortable from an HR standpoint that, in fact, the environment is cultivating the performance that they would like to see in general. They also recognize it has a cost, so that they may lose a deal or not be able to win a contract or whatever in the sales area. So they actually do expect the company to advocate some other improvements, other investments in the business model that would enable them to still compete, if you will. And I think that, you know, just to underscore, as you look at deals in China, it's probably, this probably reflects one of David's earliest points, it's probably true that you need to be 100% skeptical and very judicious around evaluating as much of the data as possible, because it will be rife with not so much corruption, but bribery or other kinds of things. Non-compliance, other aspects that actually suggest that corners have been cut and the like. And one of the reasons is the rules haven't been in place, and the behavior expectation has also been deficient. So, you know, it's sort of to be expected that it's probably the most common method. But you can't stand for it. My sense is ultimately you want to stand for what's right and really try to strive for that. I think thirdly, there is a very weak underbelly to most multinational corporation activity in China right now that is has largely been under-recognized and is probably something that's screaming for attention from the companies before the Justice Department brings attention to these points on their behalf. Because there's been a lot of growth in China, and you've got to wonder how some of that fast growth has occurred, how much has been bought in a sense, or facilitated by techniques that weren't exactly right. If you think this is a remote issue, just look at Walmart in Mexico, or look at Caterpillar with their recent China deal and the write-off of $500 million. Where, you know, they discovered problems in a company they thought was actually run by Westerners and a Chinese management team, but got surprised in the end. So a lot of these issues are lurking, and at least at the board level for most American multinationals, it's probably necessary at this stage to take a second look and just make sure everything's you know, up to compliance standards, so that you're not surprised by a whistleblower at some point.
And we are under the time pressure. Please be brief, Dave.
Sure. 25% of DOJ's FCPA prosecutions are in China. There's no head in the sand exemption. It's knowledge plus participation. It's very high on the radar screen of DOJ and now the UK authority. And I do think these trade-offs for other business equalizers are useful, but I think you need really physical control to ensure you're going to get there. So when we have the ability to do it, we ensure we have a CEO that is on board. That's usually the chairman or the founder. That's the most difficult set of conversations to have. We always try to have the CFO, and the guy who's usually responsible for the problem is the head of sales. And those are the people you got to fix, and often you have to fire someone to make that happen.
Thank you. And I want to make a comment. The U.S.-China Chamber of Commerce has been doing business with China for over 10 years. We have not paid a single penny to anyone. We have not brought any Viagra, iPad, iPod, iPhone to China. Why? We still do business with them because if we provide value, we do the best work. When the delegation comes to the United States, we host the best reception. When they come here for training, we find the best company for them into. We spend a lot of time in coaching them. We found out that if you provide value, if you have something you offer them that they cannot find elsewhere, you don't have to pay the money. If they ask for money, you just don't deal with them. We never have the problem. In the last 10 years, on the contrary, every time we go to China, they give us a lot of gifts. I don't even bring gifts to China. If they understand that, if we do the best work. So when I think that if all of us here, you provide the value that nobody, no competitor can compete with you, you don't have to pay any money. They need you. The key thing is they need you. If they need you, they will not ask for money. So I think that's important. And I really appreciate that, but let's open up the floor to everyone, and then if we have probably 15 to 20 minutes, and at the end, I would like to ask each panelist make the closing statement in 3 sentences. Number 1, what opportunity that you see in China? What industry that makes sense? And third, how do people here can go about? Please. Yes, please.
I'm curious to know the panelists' point of view on this. Recent allegations about government or military hacking or cyber attacks, the key word you used is trust. Where do you stand on all this, and what impact will those allegations have on everything you talked about?
Who would like to go first?
Well, just quickly, I would suspect that some part of those allegations may have merit. There's certainly more facts coming to light now, which helps to air the issue properly. And it's probably not inconceivable that Chinese espionage today is based more on cyber involvement than, say, in the Russian era, when we had more spy-type activity, if you will. So we're in a different era in terms of the governments dealing with one another in that regard. I think where it comes home is in the theft of corporate secrets, because we're losing billions in the R&D equivalent when a lot of these design ideas for space apparatus or aircraft or other kinds of things shift hands, unfortunately. And I do think calling out the Chinese government on this is a necessity. I think there are some groups within the Chinese government who actually do want to promote a stronger rule of law around innovation, because they actually see that as the right approach. And our calling this out gives that faction, if you will, some additional strength within the politicking that is to be expected within Beijing.
Do we have any other comments? And yes, please. Well, and you go, and you come next, please.
For a U.S. company, a middle market company that wants to do business in China, to sell their product in China, how are the distribution channels different than other parts of the world? Do you use an independent trade representative? Do you use a distributor for the entire country? Do you use a joint venture? Or do you do things differently in Shanghai versus Beijing versus Chengdu?
All of the above, and I think that's what we as small and medium-sized businesses have to be careful of. You really have to do your homework and really understand how the market for your product in China is affected. Because if you go in and you just give someone distribution for the entire country, it may be, that person has coverage in Shanghai or Beijing, but they have no capacity to go elsewhere. And my experience has been that normally they won't go anywhere else. And then you're tied up with that one company, and you don't get any business out of them. And their expectation is that you're going to provide all the marketing tools, you're going to educate all of the salespeople how to sell the product, you're going to pay for it, and you're going to then support them with all the necessary materials so it can happen. They're not going to put a penny in except what they can get out of the product by selling it, and they don't understand that all those things are required.
Well, and let me add a few things. The first thing, in my opinion, is you have to do 3-question testing. Number 1, what proprietary feature your product have? If your product can be made in China day in and day out, forget it. You are not going to be able to sell to China. Second, do you have a name recognition? If your product is generic name, nobody knows, it is very, very difficult for you to sell in China. The third thing is your product competitive in America? If you cannot sell in America, the chance of you selling your product in China is not high. That's my opinion. In my opinion, you have to do those 3 questions first, otherwise don't waste your time.
But to add to that also, if you haven't sold your product outside of the United States before, don't make China the first market. Cut your teeth on another international market or another developing market.
Canada.
Canada would be great.
Canada,